Have you ever wondered how to get the most out of your real estate investment? Well, stick around to the end of this video and we'll show you exactly how to leverage your cash so you can get the ultimate return on your investment dollars. Hi, I'm Olivia Kirk.
And I'm Tim Urick. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, please be sure to subscribe to our channel and don't forget to hit the notification bell to be notified when we upload new videos. Now, before we get started, just note that we're going to be showing you an example today about how to leverage your money for real estate investing, but know that this concept applies to any type of investment, not just real estate. So keep in mind as we go through this video what you might be able to use this for in your life.
Today we're going to show you how using cash value in your life insurance can maximize the rate of return on your real estate investing. We have clients who invest in real estate who tell us, why should we put money in a life insurance policy and earn a measly 4% when we can put money in a real estate deal and earn an infinite rate of return?
Today we're going to look at a real estate example, and we're going to show you 3 different ways of acquiring the property: paying cash, financing with a traditional mortgage, and leveraging your life insurance cash value. And we're going to show you how leveraging can actually get you the ultimate rate of return on your investment. So let's get started. First, with paying cash for the investment.
Again, we chose to pay cash here, and it's a $250,000 property. After closing costs, we have $255,000 of our own money in the deal. We have no cost for financing, and after taxes, insurance, and maintenance, we end up with a gross rental income of $2,500 per month. We're going to sell the property in 60 months, and we're going to assume that the value of the property appreciates at 2% per year over that ownership period. So when we sell the property 5 years later, the value of the property is $276,270. After we calculate everything that we received, we end up with 13.08% as a rate of return on the real estate investment.
Now, you may be wondering, if the property is only appreciating at 2%, how did we get a 13.08% rate of return?
Again, we have to evaluate the fact that we received $2,500 per month for 60 months. And when you calculate that income versus the money we had in the deal, that's how we can calculate a 13.08% rate of return. That's a pretty good rate of return, but it can be so much better if we apply the laws of leverage to the purchase of the property.
Now, most people think that because we're saving so much of interest by not financing, by not using a traditional mortgage, that this rate of return is as good as it gets. But we're going to show you why it's not what you buy, but it's how you pay for it, and how using leverage can actually get you a higher rate of return on your money. Next, let's look at the classic 80-20 finance. We're going to finance 80% of the purchase price, put 20% down, and pay closing costs out of pocket.
So it's the same deal. It's the same building, same purchase price, same closing costs. The only thing we're changing is the fact that we're using other people's money. We're going to borrow 80%, $200,000 at 5% for 20 years. That means we have a mortgage that we didn't have by paying cash. And the mortgage is $1,320 per month. So how are we going to pay for that mortgage? We're going to pay for it from the rental income, the $2,500 per month. We're going to evaluate this over the same 60-month period, and we're going to sell the property again in 5 years at 2% annual appreciation. And again, we only have $55,000 of our own money in the deal. Because we have a mortgage cost, we're also going to get a tax deduction because a portion of the mortgage is interest. So now we have less monthly income, $1,180 versus $2,500, but we also have less of our money in the deal. So when we sell the property, the fact that we have a mortgage doesn't change the selling price of the building. It's still $276, $270. The only thing that changes is when we sell the building, we have to pay off the mortgage. So our net cash out is lower. It's $109,380.
Now, you may be thinking with a lower cash out and a lower monthly income, it's really surprising that the rate of return is actually higher when you finance.
Right.
But you need to consider that we only have $55,000 in this deal.
So our real estate investing clients, they understand leverage and they would never pay cash for a building. I mean, think about it. If they have $255,000, they can buy 5 buildings instead of 1 by not paying cash. So they understand leverage. And that's the beauty of using other people's money.
Right. Would you rather earn 34.37% on one property or on 5? So let's take a look at the final scenario where we finance 80%, but we borrow against our life insurance policy for that 20% down payment. And so the only payment we have out of pocket is the closing cost of $5,000. We have the same property, $250,000 with the same closing cost of $5,000. But this time we're going to mortgage the $200,000 just like in the last example. We have a 5% loan for 20 years and we have the same mortgage payment. The difference is we're going to take $50,000 against our life insurance policy and we're going to finance that at 5% for 20 years also. So our total mortgage payment is actually going to be a little higher and our monthly cash flow is going to be a little lower.
So when we sell the property for $276, $270 after 5 years, our net cash out is $67,633 because we have to pay off the bank mortgage and the loan we took against our life insurance. But remember, we only had $5,000 of our own money in the deal. This is the ultimate leverage. Looking at it, when we calculate all the income that we received plus the appreciation of the property, we end up with a rate of return of 245.87%. Now, you might be thinking that's a great rate of return, and it surely is. But actually, this scenario is so much better because what we didn't tell you is the fact that when we borrowed against our life insurance, our money was still continuing to earn uninterrupted compounding of interest at the rate of 4%. Additionally, we have a death benefit. So we have so much more than we're actually showing here that we couldn't and didn't calculate into the rate of return.
This is why it's not what you buy, but it's how you pay for it that really matters, and how leveraging can really increase your rate of return. And I think we really illustrated that with these examples today. You know, conventional wisdom would have you believe that the less you pay the banks and finance companies and fees and interest charges, the greater rate of return you can earn. But today's example really underscores the importance of having as little of your cash tied up in the deal as possible, and how leveraging other people's money can maximize the rate of return that you could earn on your money. Not to mention, you still have control over all that money that isn't tied up in the deal. If you'd like to get started with a cash value life insurance policy, please be sure to visit our website at tier1capital.com to get started. Also, if you like this video, please be sure to give it a thumbs up and don't forget to subscribe so you don't miss any of our videos. Also, leave us a comment down below and let us know what you'd like to see next. We'd be happy to answer any of your questions.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters.